The decision to maintain interest rates at the present level was widely expected after the bank hiked the base rate from 0.25% to 0.5% last month. It comes as policymakers said that Brexit-fuelled inflation was close to its peak and would begin to ease back towards its 2% target in the medium term, after hitting 3.1% in November. It remains the case that inflation has been pushed above the target by the boost to import prices that resulted from the past depreciation of sterling, the bank's meeting minutes said. On the flip side, recession or a downward turn for the economy would slow things down. Analysts and economists were divided on the merit of today's base rate hike. Some see little as having changed to warrant a shift from a 7-2 vote to hold rates to a 7-2 vote to raise them. Others comment that this merely takes us back to pre-Brexit vote levels, and the bank had to be seen to take action. Howard Cunningham, fixed income portfolio manager at move.The, said, given the explicit guidance at the prior meeting, the market had largely priced in today's increase, but questions remain. Is it just a November gesture, or will it develop into something more substantial in the months ahead, with further rate increases in 2018? Also, will growth be so disappointing that it will look like an embarrassing mistake and need to be shaved back off at the first opportunity? In our view, it is a worthy move, and it is appropriate to reverse the emergency rate cut put in place in August 2016, both to allay any complacency that rates will never go up, and also to signal that too much inflation will not be tolerated. However, I am less convinced that further tightening is imminent, and anticipate that inflation should begin to decline, with a possibility that Brexit uncertainty may weigh on economic activity. Today's interest rate rise was widely expected after signals at the last MPC meeting, and the Bank of England doing little to dispel the belief that rates would go up. In fact, had rates not gone up today, the bank would have lost credibility in many quarters. Some have also warned that there are other factors that need to be taken into account alongside rates, including the successor to funding for lending that pumped cheap money to banks and allowed mortgage rates to be slashed. Chris Derbyshire, Chief Investment Officer, 7am said the Bank of England has raised base rates, but that's not the full story. The monetary stimulus put in place following the referendum comprised the base rate cut, a reduction in the counter-cyclical capital buffer rate, plus the term funding scheme, scheduled to terminate in February. It was the combination of these three actions that produced the formidable boost to bank lending following the referendum, and it was the willingness of consumers to borrow that has powered the economy over the past year. With defaults in unsecured lending ticking up, however, the Bank of England has decided to start taking away the punch bowl. While these changes will impact relatively gradually throughout the year, they represent new headwinds. The question is whether the strong economic momentum seen outside the UK can carry across the English Channel, or whether the British economy will suffer another year of lackluster growth. The Monetary Policy Committee voted by 7-2 to raise base rate from 0.25% to 0.5%. Raising interest rates will make little difference in this scenario, but the bank has taken the decision to move and be seen to be doing something about inflation. How high will rates go? The Bank of England Governor Mark Carney has offered many reassurances over the years that rate rises would be slow and well signaled. We import a lot of goods, food and even essential services such as energy. Petrol prices are also driven by what happens to oil, which is priced in US dollars. When the pound falls, inflation goes up, and if the pound rises, inflation should go down. The pound took a big fall against both the US dollar and euro after the Brexit vote, and this ultimately fed through to prices rising for British consumers. The CPI rise is expected to peak perhaps as early as October, at just above 3%. Inflation should then tail off and an interest rate rise will bolster the pound and contribute to that. What did the Bank of England say when it cut, laying out its interest rate decision in August 2016? The Bank of England said the following. Simon Lambert explains what it means. The cut in bank rate will lower borrowing costs for households and businesses. However, as interest rates are close to zero, it is likely to be difficult for some banks and building societies to reduce deposit rates much further, which in turn might limit their ability to cut their lending rates. In addition, the TFS provides participants with a cost-effective source of funding to support additional lending to the real economy, providing insurance against the risk that conditions tighten in bank funding markets. Translation: to encourage banks to lend more, we will supply them with ultra-cheap funds, which they can pass on to businesses, homeowners and individuals. This worked with funding for lending, and we think it will work again. The expansion of the Bank of England's asset purchase program for UK government bonds will impart monetary stimulus by lowering the yields on securities that are used to determine the cost of borrowing for households and businesses. It is also likely to trigger portfolio rebalancing into riskier assets by current holders of government bonds, further enhancing the supply of credit to the broader economy. Translation: by buying government bonds from financial institutions, we will drive up the price of gilts and push down their yields, which heavily influence rates on mortgages and other loans. Having initially formed its forward guidance on interest rates around unemployment, the Bank of England switched tack when this fell far faster than expected. The UK interest rate outlook underwent a transformation with this initiative from Mark Carney in summer 2013, which was launched alongside his first quarterly inflation report as Bank of England governor. He pledged that rates will not go up as long as the unemployment rate remained above 7%. The bank initially projected a very slow recovery that would not see it fall below 7% much before late 2016. This was then changed to 2015 as unemployment fell swifter than expected. Unemployment actually dropped below 7% in January 2014. By November 2015 it was at 5.1%, and by June 2016 it was 4.9%. The bank says that some of this slack had been used up, but there had actually been more of it than first thought. It now also looks keenly at wages, which, although having risen at a faster pace than in recent years, remain some way below where they would be expected to be at this point in a recovery. Brexit added an extra element to all of this, however, and led to an emergency rate cut, rather than the expected hike. There is now little forward guidance on where rates are headed beyond the usual pronouncements. The bank says the next move could be up or down.The funding for lending scheme overtook key in 2012 and 2013. This was designed to allow banks and building societies to take cheap cash from the bank and pass it on to mortgage borrowers and businesses. The bank later switched off the taps on more funding for mortgages through this, although lenders could still tap into their existing allocation. Read the Council of Mortgage Lenders Guide to Swap Rates. Important note: markets, economists and other experts haven't had a great record of making the right calls in recent years. This is Money has always advocated caution with any sort of prediction, including our own. There's no guarantee that those who have made correct calls in the past will make them in the future. We'd also urge consumers not to gamble with their personal finances when it comes to predicting rate swings. The BO's Monetary Policy Committee meets once a month and sets the bank rate. Its government set task is to keep inflation to a 2% target and nowadays also maintain financial stability. So if inflation looks likely to pick up, it raises rates.